Chris Rupke, Chief Financial Economist, Bank of Tokyo Mitsubishi, is joining in on the phone line right now. Chris, thanks very much for joining in. Good morning here from India. You know, net-net, fairly upbeat data on Thursday. Will that prompt economists to further temper expectations of perhaps a sharp moderation in growth in the first quarter in the U.S.?
Well, that's an interesting question. In fact, yesterday there's GDP growth, and that's a measure of output, and so is industrial production, the Fed's number that comes out every month, that's output. You would think the two kind of move hand in hand. Anyway, yesterday with industrial production, it was revised up substantially, and it looks like it's headed much higher in the first quarter. But, at the moment, I think economists here are still, they're still downplaying the strength of the recovery here. There's been no major revisions that I know of at the moment. I think most of the estimates for growth in 2012 are something around 2.0. The Fed has about 2.7. I think on the Fed's basis of measurement, it could be a little bit faster, 3.2. But yeah, we're just in the discovery period. We're getting all these economic reports that are coming in better than expected. The unemployment claims that you pointed out today, very, very low right now, and it suggests we'll get a third monthly increase in payroll jobs when it comes out on March 9 of 200,000. That's about as fast as the economy can run. That's about as many people who could be put back to work will be put back to work. So it was very good news today in terms of the unemployment claims and what it may mean for a third big month of payroll jobs when it comes out March 9, we hope.
Chris, Moody's is watching out for the ratings of Bank of America, Citigroup, and also Goldman, a couple of other major banks out there. What's behind Moody's, this sort of decision? Are we looking at a possible downgrade there?
That's what they appear to be saying. I'm not a big fan of the rating agencies rating sovereign countries, major countries out of Europe at this stage. It's almost as if it's a death by 1,000 cuts for the market. There's always room for another one-tick downgrade on the part of Moody's or S&P. It's unfortunate that they've done that. I understand banks are under a lot of pressure. We had investment banks up until Bear Stearns went under. Now we don't have investment banks anymore. We have everyone's a bank who can borrow from the discount window. The Wall Street business model, pre-Lehman, pre-Bear Stearns, is under siege at the moment. The revenues are down. Prop trading is being eliminated. The way forward in terms of generating big dollar earnings for these companies' share prices that backs up the company's share prices of these former investment banks, it's unclear. So I can see what the rating agencies are doing, but hopefully investors can look past it. I'm a little bit more optimistic than the rating agencies that these companies will come back online. There's the baby boom generation is tremendously wealthy in the U.S. They're going to need security products. So I'm hopeful that securities firms, the old securities firms, will be able to make more money than people anticipate at this point going forward.
And it's always so good to hear, optimism right in the morning. Chris, thanks very much.